Okay. Doctor, can you see the slide?
Yes, I can.
Okay. Okay, I can start.
Yep.
Okay. Assalamualaikum and good evening to Dr. Khadijah and to all fellow friends. My name Hanani. Together with my team members Abigail and Shakirin, would like to discuss about the property development and taxation. Okay, development units is a unit of residential, commercial or industrial building and vacant lots that develop for sales. Property development is a activities acquiring of land for the purpose of constructing, selling completed residential development and sales of vacant lots. First is date commencement of business. According to the PR 1 2009, the date will be when some significant activities or essential preliminaries are undertaken, which is physical possession of the land and the activity development of the land. For example, leveling of land or piling and booking of houses by buyers. However, according to the PR 2 2002, the purchase of land also can be the date of commencement of the business. So let's look at the example. Example 1, Company A, they bought a piece of agricultural land and applied for conversion of housing land. The relevant information are as follows. So the date will be on the purchase of land, which is 12 February 2006. Because the company is because the company itself is a property developer and the activities closely follow one another. So example 2, Company B, they purchased a piece of land on 3 November 2002 with the intention of carrying out the business of property development. So the relevant information are as follows. So for this example, the essential element of indication the date of commencement of the business activities is the commitment to the project and activities undertaken, which is on the application for conversion and subdivision of land, which 3 January 2006. But according to the DGIR, any other date can be considered as the date is appropriate and reasonable. Second is recognition of income prior to completion of projects. According to the Section 24 ITA, the gross income of the property development project need to be assessed on a receivable basis. But according to the PR 1 2009, the income need to be recognized as development activity progresses based on the stage of completions. So the common way to determine the stage of completions are based on progress billings, based on costs incurred to date, and based on surveys of work performed. So the recognition of income should be commenced when the sales of the development units are affected and upon commencement of development activities. Income property of the developer should be the estimated gross profit by using the formula given, which is A divided by B and multiplied by C, where A stands for sum of progress payment, B for total estimated sales, and C for total estimated gross profit. So let's look at the example 4. For a single phase project, Company D, they commenced a housing project in 2005 and the estimated completion in 2008. So the information given is the total estimated sales 24 million, total estimated cost 60 million, and the estimated gross profit 8 million. So the payment received and receivable are as follows. So the answer will be like this, where the estimated gross profit for the year 2005 is 1667, 2006 is 2666, 2007, 2000 and 2008 is 1667.
Okay,
However,
Hanani, stop. Sekejap. Let the students absorb the information
okay,
while you're listening to your presentation. Okay,
okay,
remember that
Doctor.
now the formula is A over B times by C.
Uh-huh.
A is the
Sum
payment
of progress payment.
sum of progress. So it means that it has to be total, is it?
Yes.
Ha. Sum
Total for the
of that
year.
total for the year. B is
Yes.
the total lah.
Total
B
sale
is here.
for
So the amount that changing is the A lah. B and
yes.
C the same. Okay, next page. Okay,
This
now
is
you have as much as 24 million and then you have gross profit of 8 million.
uh,
So now up to 2008, you have made payment of 24,000
uh,
total, right? But you want to look at for each year of assessment, what are you counting A, B, C tu apa benda?
to calculate the gross profit, gross income,
Sure.
estimated gross profit for the year.
Itu memang given. A over B, C tu apa?
A is the
No. What is that A, B, C tu?
It's to find the
Right.
estimated gross profit for the year.
You want to find estimated, the given already. Estimated gross profit is your 8 million. You nak cari
Tak, Doctor, yang 8 million tu is for the project, the overall project. The one we are calculating now is for the year.
Okay, you nak compute for the year.
Yes.
Estimated profit.
Yes.
So based on the estimated that you're going to use A, B, C ni, you akan compute tax liability, is it?
Yes.
Yes.
You jangan terus, I tak tahu. I don't know, I tak tahu lah. I don't know lah, students may be doing very well lah kan.
Okay.
Yeah, you remember because when you present, you want people to understand your presentation, not just reading the slides. Okay? Take some time, right? So for people to absorb the information. Okay, now let's move. A, B, C. So sekarang ni you nak kira estimated profit for the year. Okay, now go to the example. Next.
Okay. Next,
5865, okay. 5, okay, so for every year, you have total payments. 2005, you paid 5,000, 8,000, 2007, 6,000, 2008, 5,000. Then for 2005, you want to compute estimated gross profit for the year, which is based on the payment over sales, estimated sales and gross profit for the year, is it? Oh, itu sama for the project. So 1667 means that is your estimated profit for the year. And then change. Okay, then next what? Pelan-pelan tunjuk ni kalau orang tak absorb tak guna. Sia-sia je you prepare berapa hari.
Okay. I proceed at that time. Okay, for the amount in the year 2008, according to the questions, the project will be estimated complete in 2008. So the amount will be replaced by the amount actual received by the company, which is the actual profit less the estimated gross profit for the year 2005, 2006 and 2007. Okay, so next, example 5 is regarding the multi-phase project where the company have 2 phase in the project where phase 1 completed by 2008 and the phase 2 by 2009. So this is the information given where the total sales value of the project, total cost and the estimated gross profit and the payment received and receivable for phase 1 and also phase 2. Okay, so the calculation will be like this. The calculation is similar with the example 4, but this example they show that for estimated gross profit for phase 1 and phase 2 they differentiate it. Okay, so next, we also can use the other formula which is the percentage of completion method. This example they provide the number of units built, number of units sold, sales price per unit, total cost, exclude land cost, cost of land, budgeted cost per unit, total sale value of units sold, total budgeted cost of units sold and percentage of completion. So how to get the percentage of completion is we take the amount of cost incurred to date, which is 11 million, divided by the total cost, which is 21 million, multiplied by 100. So how to calculate the income, which is we take the amount of total sale value of units sold, which is 12 million, multiply by the 52%, which is the percentage of completion, and similar with the expenses, so we get the attributable profit or loss. Okay, I continue.
Katalah you nak summarize lah, alright? Because you have to differentiate between this information, but logically, this formula actually based on percentage of completion. So you look at the cost and the sales, kan? Cost to date is the 11 million, and over the sale price is, what is 21 million? Total cost, right? So total cost 21 million, but to date is only 11 million. So the cost to date maknanya is only 52%. Cost to date over total cost is 52%. And based on that, you kena profit pun based on 52% lah. You nak recognize profit for the year up based on 52%. So what is your profit? Sale price, kan? Not profit lah, you nak take profit. Sekarang ni profit makna sales tolak cost. Sales price minus cost. So sales price kat sini is 300,000. Is it salah? Salah. Mana sales value?
Betul, dia ambil sales price per unit kalikan dengan unit sold.
So that's how you get 12 million. So that's your sales value, 12 million. But of that 12 million, you can only recognize 52% of that. Completion is only 52%. So sales value minus cost. So cost also you're going to recognize only 52%, which is actually 5,000, 5.2 lah. You tak akan ambil cost incurred to date now. You akan ambil, kalau cost incurred to date is 11 million. Kan? Tapi you won't take that 11 million, but you will take 52% of the total cost. Nampak tak? Kenapa you tak ambil cost to date? Logically. Sebab formula dia macam tu. Sebab dia pakai percentage completion. Alright, so you punya sales pun based on percentage completion, 52%. You punya cost pun you don't take 11 million. You only take 5.2 million, which is lower lah. Yeah. And then from there you dapat 1.04. That is your profit to be recognized for the period, isn't it? And that profit will be taxed accordingly. Okay.
Okay. Okay, next. Okay, once the income of the property developer has been ascertained, the formula used must be used consistently until the project is complete. So the result should reflect a fair spread of the estimated gross profit. So for example 7, the company G, they commenced 2 projects in year 2005. They use the percentage of completion method to recognize the income. So in year assessment 2006, company G decide to switch to using another formula, which is cost to date formula. So company G can use the formula starting year assessment 2006 onwards. However, whatever formula they adopted for each project must be used consistently until the project is complete. So when they're using the formula and there is a resulted to the distortion of the fair value true and fair spread for taxation purpose, DJIR should review assessment for all relevant years to ensure that there is a true and fair spread of the estimated profits.
What do you mean by there's a distortion there?
Maksudnya macam ada apa tu? Apa maksud distortion?
This is based on your understanding.
Distortion macam ada kesalahan macam tu lah.
No, it's not, because kan you ada few methods kan? The methods of estimating the profit for the year. So you ada method 1, method 2, method 3. So if you were to change your methods, alright, they have to make sure that okay, the method yang you pakai, the new pakai is still true and fair spread of the profit throughout the periods lah. Right, dia tak nak lah, katalah for example this year you pakai you panggil apa, method number 1. Method number 2, alright, method number 1 for example lah, estimated profit becomes 100 million. But because 100 million, then year 2 you change to method lain. And that method only give you 50 million. Right? And then it goes further down lah. So maknanya pada 100 million ke 50 million is not true and fair spread lah. Bila track to and fair spread, maknanya profit tu should be, if katalah project 5 years, so the profit should be spread over 5 years period, true and fair lah. Tak adalah dia keep on up and down, because of course if you don't have that, then a company will always try to minimize their estimated profit, but they don't want to pay tax in that year. So they will look for methods that will give lower tax, lower estimated profit in order for them to avoid tax. Alright, so that's why RB, you do have all the methods, but they have to control. Otherwise, company will manipulate. So that's why dia akan kata bila you change the method, RB will review the assessment to make sure that, alright, whatever method that you use, the spread of the profit is equally lah, fairly. Right?
Okay, Doctor. Okay, and next for income tax treatment for the property developer. So once when property developer prepare his accounts by using the completion of contract method, they are required to compute his income tax liability by using the similar method. So they are not permitted to defer the recognition of profits in the accounts until the project is complete. Okay. The next is separate source of income. Although the development project is considered as a whole, but the company need to treat each property to treat the source of income as a separate and distinct. So let's look at the example 8. Company H and with the accounts ending on 31st December each year, for year 2007, Company H has a project with 3 phases, which is phase 1 condominium, phase 2 double-story terrace houses, and phase 3 double-story semi-detached houses. And the other information given are estimated gross profit, allowable expenses, and capital allowance is 318,000. So the answer will be like this, where the gross income for each phases, they separate it. Which macam nak cakap Doktor? Yang 4 ni saya tak faham sangat lah Doktor. Doktor.
Sorry, you cakap. Alright, for property developer, it's common for them to have many projects. Alright, so for each project, they have to recognize income separately. Betul tak? Boleh cakap income separately kan? Each source. Right, but treat each project as a separate and distinct source of income, although that one be said as a whole. So they still regarded project tu as a separate business income. But then for income tax purpose, they akan combine, right? You still have to recognize each source of income, right? Project 1, 2, 3, but then you combine together, tolak allowable expenses. So let's look at that. Right, allowable expenses, then you put adjusted income, then you minus your capital allowance. Initially, I thought macam mula-mula when I heard that, I thought that okay, you're going to apportion the expenses and capital allowances accordingly kan. Tapi ni jawapan dia. So it means you combine lah. Macam juga macam contoh lah, for example, if you have rental income, section 4D kan? Alright, if you have rental income, section 4D, you are the many houses. Houses 1, house 2, house 3. So dia akan buat macam ni juga. Dia akan combine your income from house 1, 2, 3 combine minus total expenses from house 1, 2, 3. Dia tak akan buat house 1 minus income for house 1 minus expenses house 1. Income house 2 minus expenses. No, dia tak akan. Dia akan combine the income. But each income you tak boleh combine all the income under satu. You still have to put that under separate source of business. Right, but when you come to computation, you have to identify, okay, total income from project 1 to 3 minus all allowable expenses from 1 to 3.
Oh, okay. Okay, faham Doktor. Thank you Doktor. So next, I will pass to the Abigail for continuing the discussion.
Okay, thank you Anani. So good evening everyone. I hope you all are still alert. I'll be presenting on the next part, which is the estimated loss of uncompleted project. So just now, as we saw, we were looking at the profit. So when the project is being process the estimated profit from the project. So now in the estimated loss of uncompleted project, there is three things that we will look into, which is first the computation of estimated loss. Okay, so for computation of estimated loss, we will use back the same formula, which is A over B times C. But in this, we will replace the total estimated gross profit to the total estimated loss for the project. All right. So if the base, what else we can see in this is when there is a loss which is estimated for the year, the property developer can set off the loss against the aggregate gross profit for the other project on the same base year. Like just now we saw previously Anani presented, she said there is the developers will come up with many projects in the same year. But then we can say from the three projects, maybe one project may face loss, and they can set off. That means they can cover up the loss by the aggregate gross profit from all three projects. So that is what is being said. Okay, let's say next. The next one is the estimated loss is less than the estimated gross profit. So when the estimated loss is less than the estimated gross profit, the difference is the gross income for the developers. So the calculation can be like we can say there's three. Okay, let's say now developer Jaya Grocer developer comes up with three phase of apartment in Shah Alam. Okay, so phase one there is profit, phase two there's a loss, and phase three there's also loss. So the phase one profit is 3,000, 100,000. Second one is 1 million, also a million loss. So when there's 300, there's a 3 million profit and there's a loss for 10,000 and 15,000. So what we can do is when we total up, the total loss for this phase two and phase three is 22,000. So the 3 million minus the 22,000, you will still have a profit of 2.75 million. So this is the estimated gross income. So this will be for the year. Okay, let's say the phase one, phase two, phase three is in the same year. So can you understand this part? Okay, so the next one will be the estimated loss for more than the aggregated estimated profit. When we say like, okay, phase one, the same company, the phase one, they have profit of 3 million. But then when it comes to phase two and phase three, their loss is 1 million and 1 million and another 2 million. Phase two is 1 million and phase three is 3 million. So their estimated loss itself is already 3 million, and their first phase, the profit is less than that. So what they can do is they can write it off as a loss for that particular year. But then when they have the actual loss, then they have to recalculate it again. But they will use back the same formula, which is the A over B and times C. Okay. So for the next one, we will look into the revision of the estimation and the tax computation. So there are some factors that we will. What are the factors that allows for these circumstances to take place? First, there is a variation in the development cost of the project. So let's say when we come up with a project, we can see when around us, when a developing project takes place, there's so many materials and everything they're using. Sometimes there might be problems with the contractors. They might change the contractors, or there might be a hike in the price of the materials that they're using. So maybe what they have estimated and what they are having now can have difference. So this will allow them to revise their estimation for the following year. Maybe the project is 3-year based, but then the first year they estimated in a lower cost, but then when it comes to the second year, they notice there's a higher there's an increase in certain costs that they have to recalculate it. So this is one of the variation. Second, the variation of the selling price of the development unit. So sometimes when you have changed in the cost, the price of the selling unit will also increase or maybe decrease. It depends on the cost that has been used. And the third thing is any computation which reason that may be acceptable by the DGIR. Okay, so maybe there is certain reasons when they go and refer to the DGIR and it's acceptable by the ruling, and they can do the revision of the estimation. And the circumstances can result in change of the estimated gross profit and give a rise to one another is the estimation of the gross profit is reduced, and the estimation gross profit can become an estimated loss. So when they do all this revision, there can be a change in the profit where it can reduce, or it can it reduce as in there's still a profit, but it also can reduce to become a loss. And property developers may revise this estimation gross profit for the base year and for the immediate following base year. That means if I'm going to revise my estimated profit, I can do it for the coming year, which is 2021 and also 2022, using the that means using the current figures that I already have, and the prior years of estimation will. That means this year's one, that means 2020, I cannot do any changes because the project has been done already. So we use the cost that whatever we already estimated in the previous years. Okay.
How does
So we,
that, Abigail, how does
Yes,
this,
Doctor.
all this revision of estimate differ from other company, from normal company which is not property developer?
How it differs? Uh, Doctor, that means how it differs if it's not a property development, is it?
Yeah, it's a normal company.
Okay, if it's a normal company, I have no idea really, but then from what I can understand this is for property development, their estimation is for a 1 year base. It's according to the base year that they have. But I think maybe the normal companies, it goes according to monthly base. So it doesn't change much of their project because when a property is already there, there's a fixed price for the selling. They already have an estimated price for the selling price. So if they're going to change a lot of things, then it might affect their selling price and also the later on profit.
Yeah, I think that which is maybe to say that for normal companies is always you have estimates. All right, if you still remember, this one is your tax one punya topic. So you have to come up with the estimates of your tax liability. All right, estimate of your is it tax? You estimate apa?
Yes.
Tax payable, is it? No.
This gross profit dengan
Whatever lah, you estimate. All right, based on that, you determine how much is your installment payment from there.
yes.
For normal company, for example, you're talking about trading company. So you can actually revise your estimate. All right, first you have come up with the original estimate 1 month before the start of your business. So during the year, you can actually revise your estimate, right? Because you want to revise your estimate maybe in the 6th month or in the 9th month or both. And then at the end of the year, then you close, then you see how much your actual tax liability. So how this different is that because normal company, they have just 1 year period. Then they know what is the income and whatever tax liability for that year of assessment. But for property development, all right, their projects are longer, right? So in 1 year, they may not actually have their actual profit, all right? So that's why they come up with the estimate. So because the profit will only you can only have estimate from 1 year to another, so that's why you revise your estimate on a yearly basis, right? So only later, for example, maybe in the 3rd year when the project completes, then only you see how much your actual tax, then you compare that with your estimate and how much you have paid for the installment, isn't it?
Yes.
Okay.
Okay. Thank you, Doctor. Okay, so moving on, will be the next subtopic from this is withdrawal of purchase. So when a property purchase is a property when a property purchase is surrendered or he or she withdraws from the purchase. Okay, let me give you in a simple words. So let's say now I'm going to buy a house, but then it comes a point where I decide again not. I have paid my down payment or my a few installment prior while the construction is going on for the house. But then halfway through, I decided not to continue with my payment. So I withdraw myself from the purchase. I'll meet the developer or the agent and say I'm withdrawing myself. So on my part, I will lose the money. All right, that's it's a loss for me. So whatever down payment I have paid and whatever installment I have paid, it is a loss for me. The As for the company or the developer, they will what they can do is the payment will be made. They will make the adjustment to reflect to say that there is a withdrawal of purchase, and this adjustment can be or will affect their assessment for the current year. That means I have finished my payment for 2020, but I'm withdrawing on 2021. So what they will do is whatever I paid for 2020 is already calculated into their account, but they will take it. They will consider the withdrawing on 2021 only. They can't reopen this account already because it's already end of the year, and maybe I'm doing it on January only. In January only, I'm withdrawing it, so they can't reopen the account. Or I'm so sorry, it's not January. After the tax assessment has been done. So when I withdraw right after the tax assessment has been done, it's the developer can only write off this withdrawal in their next coming tax assessment. So this loss, they might pay me back. There will be some there will be contracts saying how many percent can be paid back and how many percent they can't pay back. Okay, so that is the thing.
Payback
It's
means a refund to the
yes,
purchaser.
refund for the purchaser.
So for example, if assuming that you can refund 50%,
yeah,
so the balance 50% recognized as income
for the following year
to the developer, yeah.
to the developer. Yes,
Okay.
but they can't reopen the assessment year which
So they
I
will
have finished paid for.
So they will recognize the income in the year of the adjustment.
Yes, the current adjustment year.
All right.
Okay, so next we will see on the completion. Completion of the project. So when is the project is considered completed? So there are 7 things that we will look into. The first is the date of completion of the project is when you get the temporary certificate of fitness of occupation is issued, or the certificate of fitness of occupation. So there is these 2 certification. That means like we have OSH for safety and health for employments and everything. So for when a building is built, there will be also people who will come and check the place whether it's safe to be occupied, whether it's safe for me to go and stay there, for me to work there. So when there is a certification saying that it's safe to be to be to be open for people to stay in or to work in or to purchase the building, that is when it's considered completed. So this
that
thing,
A and B, is it the same or what?
okay, it's not the same. One is
temporary certificate.
One is temporary certificate. That means you get it, and
Yeah.
one more is the
Okay.
confirm one. So this is effective when either one of it is the dates, whichever is earlier. Any certificate can, maybe you will get your one earlier and the other one maybe not earlier. Okay. So maybe I would okay, that's it. Okay, the next okay, there can be other certificates also which have the similar effect. That means is if I didn't get my TCFO or my CFO, I can maybe have another certificate which has the same effect. That means which like we can get our OSH certificate or other certificates telling that the building is safe enough to be in. Okay. Next, when the developer is required to obtain this CFO. Okay. So once the developer have finished developing the units and everything, the developer has to apply for this, and when they apply for it, it's already considered that the project is already completed. And okay, when a phase is okay, next, moving on to the third point. Okay, for a condominium, there is condo A, condo B, and condo C. So these are considered phases and by block. And they might have separate CFO. So and it might be coming in a different date. So it goes according to that block. That means condo A has already get its approval. So condo A the whole project is considered completed also. All right. So whichever is earlier. Okay, so next one is for the preparation of the final account. So when in the base period of the year of assessment of the property development project is completed, the property developer is need to assure that what is the actual gross profit and also the loss of the project to prepare the final account. And the adjustment of the profit or loss is to comply with the rulings that is available and all the other treatments, and according the rulings and the treatments. Next, the tax treatment upon completion of the project, that the property developers need to have the actual gross profit or loss stated. Second, they have to make sure whether the actual gross profit is more than the estimated gross profit. And third, they have to make sure that there is if there's a loss, I'm so sorry. The third thing is they need to make sure whether the actual gross profit is less than the estimated gross profit, or the project is actually estimated loss. So these are the four things that they have to consider and treatments that they have to do before telling that project is a completion project. Okay. And next will be the current, sorry, I can't say. Okay, concurrence of the multiple projects. As we know that developers will not just focus on one project for the base year, but they will focus on many projects at the same time. So this project can be completed in the same base year, and they can launch a new one in the same base year. So they have to also check on the concurrence of the multiple project. And finally is the individual developers. So as for the individual developers, they have okay they might like come in and joint venture with the main developers, and their personal rate of income tax may fluctuate. So they are allowed to review their prior year assessment and to upon the completion of the project. So for example, a individual contractor is calling to come and develop the housing project in 2015, and he has to and he finishes it in 2017. Upon the finishing of the project, he he got a profit of 1.5 million. So the estimated profit is computed as the project is completed. All right. So that's all from me. Thank you for your time. I'll pass it to the next presenter, Shakirin.
Okay, thank you, Abby. I will proceed with outgoings and expenses of property developers. First is allocation of land cost. If the development project consists of more than one phase with different types of properties, the allocation of land cost for each phase should be done by reference to land area. Um, like example 22, U Development Sdn Bhd bought a piece of land with an area of 300 hectare for 1 million ringgit. The land is divided into 4 parcels, parcels 1, 2 and 3 for immediate development, where parcel 4 is reserved for future use. Development work on parcel 1 commenced on 1st July 2006. Cost of each parcel calculated by reference to the proportion land area is as follow. So the calculation is the area per parcel divided by total land area times with the total land cost, which is 1 million. So for parcel 1, 30 divided by 300 times to 1 million. So we can get the land cost for parcel 1 is 100,000 ringgit. Next slide. Next is allocation of common infrastructure costs. The accounting standards prescribe that common costs may be allocated using relative sales value or any other generally accepted method. For income tax purpose, common infrastructure costs be apportioned in accordance with the area or the relative sales value method or any other method that is acceptable. Like example 24, W Berhad Development Project has the following particulars. The total number of phases is 5. Total development area is 30 hectares. Years to complete the whole project is 8 years. The total budget cost incurred on common infrastructure is 9 million, and the actual cost incurred for common infrastructure is 3 million up to 31st December 2006. The date of commencement of phase 1 is 5 June 2005. The area of phase 1 is 3 hectare and gross development value of phase 1 is 10% of the whole project. The date of completion of phase 1 is 31st December 2006. So the allocation of common infrastructure cost to phase 1 is as follows, which is total development area of phase 1 divided by total development areas of all phase time to common infrastructure cost. So we can get common infrastructure cost for phase 1 is 300,000 ringgit. Next slide. Next is warranty and defect liability. Any defects in a building which become apparent within a period of 18 months have to be repaired or made good by the property developer at its own cost and expenses within 30 days of receiving a written notice from the purchaser. If there is sufficient income from development projects, the defects liability expenses can be deducted against the gross income from the project. But if there is insufficient or no gross income from development project, the defects liability expenses can be deducted against same project for the basis period and carry back to prior year or against other project of basis period or future period. Basically, property developer can make election to have to deduct the expenses against the same project for the basis period, like example 29, which is company Z with accounts ending on 31st December has a project with 2 phases. Phase 1 commenced on 1st February 2006 and was complete on 10 January 2008. After serious consideration, the company decided to make an election as this Details of income and defects liability expenses are as follows. So from this example, the defect liability expenses was 42,000 ringgit Malaysia, and the tax computation for year assessment 2008 is as follow. Gross income is only 10,000, but the defect liability expenses is 42,000. So there is unabsorbed defect liability expenses of 32,000 for year assessment 2008. So the unabsorbed defect liability expenses is carried back to year assessment of 2007, where the tax computation would be reviewed. The gross income from phase 1 in 2007 is only 30,000. So it means that they still have unabsorbed expenses of 2,000. So the unabsorbed expenses will carry against to year assessment of 2006. As we can see,
Shakirin. Okay, just to
yes,
get this. Okay, in 2008, you have income phase 1 10,000, but your
yes,
defect liability expenses is 42,000, right? So because of that, your adjusted income is nil. But that loss 42,000 is more than your income. So the adjusted loss actually is 32,000 that you carry forward to next year. Isn't it?
to
The
the
32,000 tu from 42 kan?
what?
Where do you get that 2007 32,000?
The defect liability for 2008, there is unabsorbed 32,000 because the gross income
Yeah.
only 2,000.
Because in 2008, ni 2008, ni 2007. Mana
Yes,
dulu?
because
Sampai.
dia carried back to prior year.
Oh. Okay.
Sebab the project is complete on 2008.
Defect liability is 42,000 in 2008. So 2008 32 tu dia bring back, dia panggil apa? Dia panggil apa? Carried back. They carried back to from
prior
2008.
year.
So okay, class. Okay, just to get you clear, 2006 you had the income 80,000, 2007 30, 2008 10, and only in 2008 you have 42,000 expenses there. Is it?
Yes.
Before that tak ada Before 2008 you don't have any defect liability expense.
No.
So that 2008 you, because income is only 10,000, so you absorb your liability expense 10,000 only, right? So the balance 30,000 you suddenly carry forward kan, but in this case you carry back, you bring back to 2007. 2007 you have 30,000 income from phase 1. So remember you have the expenses which is unabsorbed 32. So you pakai 32 against that. So now you adjust lah, you punya income jadi nil. From that 32 you ada balance lagi tak? Unabsorbed berapa? 2,000. Right? 2,000 unabsorbed you carry back. Bukan carry forward tau. You carry back to 2006. That's how you utilize that 2,000 against your 80,000 income. Right? Okay. So you ingat dia orang faham? Dia orang faham tu? I pun tak faham. Okay, next.
Okay. Sekejap sebelum ni belum habis lagi.
Belum.
Okay. This is for if the property developer has made election, like I said before, but the property developer
Election tu apa?
maksudnya they can choose to use
carry forward.
Yes, if they not choose to carry back, they can use they can deduct the liability against the project of basis period or future period, like example 27.
27 they carry forward.
Yes. Wise Cinderella Hut, which closed its accounts on 31st December, has a multi-phase project in Penang. Phase 2 of the project, which commenced in November 2004, was complete on 30 April 2006. Defects liability expenses of 3,000 was incurred on 30 September 2006. The income tax computation is as follows. For the year assessment 2006, the gross income from phase 2 is only 2,000, but the defect liability expenses incurred is 3,000. So there is an absorbed liability expenses for 1,000, and the expenses is deduct against the aggregate gross income from other phase. Next. Okay, next is interest expenses. A property developer may charge interest expense in the development expenditure account or profit loss account. Interest paid on loans taken for financing the purchase of land and development works are to be capitalized or debited in the development expenditure account. The example 30 is the computation for interest for each parcel. Uh, and this example is same like the first example where the for parcel 1 the total land cost is 80,000. So the in sorry my mistake. For parcel 1 the total land cost for parcel 1 is only 100,000 and the total land cost is 1 million. So the total interest for parcel 1 is only X thousand instead of 80,000 of total interest. Since only parcel 1 had commenced in the year 2006, therefore only interest expense of 8,000 incurred in respect of parcel 1 would be allowed as part of the cost of sales based on the percentage of completion method for year assessment 2006. Next. Next is other expenses, which is fees paid for soliciting projects, liquidated damage, legal and professional fees, strata title expenses, and guarantee fees. For income tax purpose, for liquidated damage and strata title expenses, the for income tax purpose, provision for liquidated damage and provision for strata title expenses is not allowable. And for fees paid for soliciting project, for income tax purpose, the deductibility of such expenses would depend on the purpose, nature, and circumstance such fees arise. For example, if the service provided by the payee is only for securing the project, so the fees paid would be deemed as a kickback and would not qualify for deduction. However, if after securing the project, the payee is actively involved in the management and running the project, then the fees paid will qualify as commission or management fee and it is deductible. Next. Next is valuation of stock and stock transfer. Transfer of land as fixed asset to trading account. Where there is a transfer of land from fixed asset account to the trading account of a property developer, the value of the land shall be its market value at the date of the transfer to the trading account. That is example of case which is DGIR versus LCW. The fact for this case is on 1953, the respondent acquired a piece of land and treated as fixed asset. His initial intention is to construct a flat for the purpose of rent as investment. But in 1967, he changed his intention from renting out to selling them, and the land was transferred from the fixed account to trading account. So the issue is whether there is a trading in land and whether the land transfer be taken as cost or market value. So according to section 17A clause A, an asset is taken into the trading stock. There shall be deemed to be disposable of chargeable asset, and section 17A clause B, the disposal price of the chargeable asset shall be equal to the market value at the asset is taken into the stock. That's all from us. Thank you.
Hold on. Can you go back one slide? Transfer of asset into stock. An asset is taken into trading stock, there shall be deemed to be disposal of a chargeable asset. Does that attract RPGT?
Yes, Doctor.
Okay, and then 17(1)(b), 17(a)(b), the disposal price of the chargeable asset shall be equal to market value and the asset is taken into the stock. All right. This topic actually, we get to the transfer of fixed asset to current asset. In your advanced taxation, I think the early chapter. All right. There's one specific chapter that actually look into this lah. I think income ke something that lah. Yeah, because LCW ni is a very famous case lah. All right, because it talk about how you determine whether when you have fixed asset, for example, or you have a building, then you put that building as a trading, all right, jadi stock. So how are you going to treat that? Because it lose also the date, right? Because the disposal or this thing lah. So it's a one chapter by itself lah regarding to the valuation of stock. Dia bawa stock, tajuk stock in your advanced taxation textbook. Yeah, all right. Okay, so thank you for the group. I think that is a very complete discussion on property. You can see that, all right, this property developer, the income tax computation is not the same as a normal business. So but it doesn't fall under, fall under special industry lah. All right, specialized industry where the tax com is a different as compared to the normal corporate com that kita buat. Yeah, so you see that the method of because the method of determine how much the estimated profit is different, right? Because the nature of the business is different. That's why namanya specialized industry, right? All right. What else? Right. Okay, good. All right. I hope that the students appreciate the presentation because it's a lot and it's very important. All right. Sometimes in the professional exam, all right, question on property development sometimes
it's
comes
5
out.
o'clock.
Yeah. And then you must know lah the method of valuation or the method of treatment, tax treatment lah, how to determine the estimated profit, the method too. All right. You should be aware of it. Yeah. So katalah later lah you graduate. This one is your graduating year, right? So once you are working, all right, at least you know that, all right, for a property developer, even their accounting is not the same as normal company, isn't it? Because they also have the percentage method of completion, all these things, right? Even the income tax is also different, right? So of course it's very lengthy, but remember that this one is an exposure. If they don't present you this information, you may not aware that, oh, tax com for property developer is different. It's not same like a normal company. Yeah. So if you look into the textbook also, there are a lot more specialized industry. Why we call it specialized? Because the tax com is not the same as a normal company. Yeah. All right. So we have shipping, banking, all that. They're also specialized industry. Yeah. All right. So thank you for the presentation. All right. We can have a 5 minutes break. Can we? Because the 1 hour punya presentation tau. Penat diorang. I pun penat. Okay, 5 minutes break. Then we have the second group for presentation.